Hello and welcome everybody to Numbers Therapy episode 20. Today's episode is titled, Are We Out of the Bear? A little bit of a leading question and clickbait there, but it should make for an interesting episode. We are lights out with this episode, by the way, calling in and speaking to everybody from our mobile device as we're currently in power outage. But maybe it's just representative of the exciting 20th episode that we've hit today. So first off, a brief note from our sponsor. So if you're listening on here, it means you're probably below a certain age, and it probably means your parents, even grandparents, have no idea what you're into with Web3, NFTs, tech, social media. The Generational Bridge has got your back. Every Saturday, the award-winning newsletter goes out teaching parents and boomers about lingo and trends and implications of what younger people are doing. The result, your parents understand and appreciate what you're doing. So special access for MVHQ members. Sign your parents up now. thegenbridge.co/MVHQ. It's the best thing they'll, and maybe even you'll read all week. So why is 20 episodes such a big deal? The statistic is that 95% of podcasts don't make it to 20 episodes, and we're continuing to grow over here. So we don't normally do this, but Poop insisted that we do allow list giveaways, as of course, that's how we cut our celebratory cake in the Metaverse. And we're super appreciative, and I'm super appreciative of our crowd, and especially our live crowd. Really appreciative of the support that you guys have given, the feedback that you've all provided along the way, and for helping us get here. So next stop is continued growth and our path to 100 episodes. So in other news, Spotify archive continues to grow. Make sure to listen to all episodes there. And I would suggest listening to all of them if possible, as they kind of build on top of each other and help paint an overall picture. We'll also see some more enhanced features coming on their way as well to further enhance the Numbers Therapy product. Do continue to want to hear feedback from everybody in terms of what you want to hear. So if you have anything you want to hear about, learn about, particular guests you suggest that we have on, or someone you want to hear from, please reach out and let us know what's on your minds. And then lastly, the application to be a guest on Numbers Therapy is out there as well. Poop or myself can also guide you if you're not familiar with where this is. So for framing purposes, the purpose of Numbers Therapy is to talk through the macro and bring on and showcase our experts in here. The goals more specifically are so that everyone can understand how the big pieces fit together, make better decisions with NFTs and other investments using a balanced perspective, learn about or from some of our people in here and get different perspectives, and also learn about different areas and opportunities that exist out there as well and different ways of thinking. So as I always say as a reminder, to the live audience, there are different levels of folks who are listening in here, and even to the recorded audience afterwards. So it's really important that everybody is along for the full ride as we go through, and also that there's room for people with existing past knowledge as well. So if you're newer and there's a term that you don't know, or there's an acronym that you don't know, or something else, please drop into guest questions. Please drop your question in there. I'll make sure to push it in along the way to make sure that nobody's left behind and follows the full logic and thought of the episode. And equally, if you have more intermediate or advanced questions, drop those in there as well, and we'll try to make sure we get them answered too. This is intended, of course, for everybody. And then lastly, an important note and disclaimer, none of what you hear in here is financial advice. It's all opinions. So without further ado, and on to today's guest and episode. Our guest today, as some of you are familiar with, was guest number 1 on Numbers Therapy. And we wanted to bring him back for this show as it's a big milestone show. And also because we feel like we've reached a pretty critical inflection point in the macroeconomic climate. So we thought it was very important to talk through updates and other elements today so everyone can have a clear sense and next steps. For those unfamiliar, our guest today comes from the fixed income world, which is short for bonds and debt. And as a result, always has nice structure and insight on what things are impacting the markets on the lower risk side, and as a result, maybe impacting higher risk assets, which is where he brings in his NFT experience as well. So I always enjoy our conversations and having him on. So please welcome to the stage, Shaggy, everyone. Shaggy, what's going on today?
Oh, not much. Thank you for having me. Can't believe it's been 20 episodes. Happy to be back. And I would just reiterate what you already said, that anything I talk about today are completely my opinions. I don't represent anybody other than my own personal self and my own thoughts and opinions here. And of course, we're just going to be chatting, not giving any financial advice, as you mentioned.
Perfect. Yep. So let's start with a bit of background for everyone. Not everyone who's live or even recorded may have listened to episode 1, may necessarily know about your background. So maybe we could start with a bit of background first. So, where's your focus outside of Web3? How did you get into Web3 and trading and investing?
Sure. Yeah. Well, I've been in the boomer markets, I guess, as you would say now, for over 2 decades. Really, my entire career has been focused on the economy and watching markets, more specifically on fixed income is my expertise. So that would be, bonds, interest rates, things like that. How did I get involved in Web3? Well, about a year and a half ago, I just wanted to learn more about blockchain, the technology, and more importantly, what is it used for? Just owning a digital currency didn't appeal much to me. I really wanted to know what you could do with it. And quickly kind of went down the Ethereum route and found NFTs. And they just kind of struck a chord as something I could do, something with a digital currency. So that currency then had some value to me. And I do just kind of like the nature of kind of collecting and trading and, fast markets, very, at the time, extremely inefficient markets. As many of us that were around a year ago know, you could make enormous sums very quickly, just very inefficient markets. The markets have become more efficient as more people have moved into them and more tools have popped up. But still find it an interesting space. And, I see long-term potential with the technology and just really want to continue to follow it.
Yeah, that's excellent background. And, we actually hit on some of that in last week's show of this migration from like some of the traditional projects that we've seen and more meme-centric projects, even the definition of memes, for instance, towards, the evolution towards more real life use cases. These are a couple of things that we've hit on in the past couple episodes. And then what are the implications as an investor and trader? So maybe we can touch on some of those things today. But, more importantly, right, for anybody listening now or listening later in the recording, he just has a very, very solid background in the scheme of both lower risk investments and interest rates, fixed income interest rates, and melding that with NFTs, which, as we all know, are kind of at like the highest risk end of the spectrum, let's call it, right? So it winds up making for a pretty great foundation to be able to discuss. So let's start with that in mind, with what we think may be the elephant in the room. So what is your view about the perception of the current state of the economy and what's coinciding with the Ethereum merge? What sentiment are you seeing and hearing around?
Well, if I take a kind of step and look at fixed income markets, equity markets, there is, without question, I think some nervousness. We have an inflation issue. Of course, we all know that, and the Fed is working on dealing with that. Markets have been rather choppy. And I think this probably pertains to the NFT market as well. Almost certainly it does. As we've seen kind of floor prices of all the big projects come way down over the last several months. There's just a nervousness of what's ahead and a lot of uncertainty. And it's very difficult for people to commit a lot of capital when you have this uncertainty about what's ahead.
Yeah, that makes sense. So it sounds like, certainly from the institutional side, a bit of concern that exists there, and like you said, limited capital being committed, or at least that kind of a mindset. Is there anything around you're seeing? I know a lot of the talk that's kind of been out there, right, has been, we know we're in a bear right now, but the interest rates have been, inflation has kind of been flatlining a little bit to some extent, even though it's still a bit high. But then also we have kind of the Ethereum merge that's coming up, right? So I'm kind of getting a bit of a sense, right, that people think, or at least some people think, like maybe we're like heading out of this sometime soon, right? And maybe we're heading more towards a bull market and the worst is behind us, that kind of a thing. First off, are you seeing that? And then second off, what is your initial perspective on that?
Yeah, almost certainly the worst is not behind us. as we head into the winter and fall, yes, I think we're going to see maybe some positive signs where inflation starts to moderate a little bit, but it's going to remain well above what the Fed would deem as acceptable. And they've been very clear about this, that they are not really going to rest until inflation gets down to their target, which is closer to the 2% level rather than the 8% level we're sitting at currently. So there is a lot of work to do. And almost certainly the only way we can get to that type of inflation level is by bringing the demand in the economy down. So how do we bring the demand in the economy down? Well, you simply you have to hurt the labor force. You have to hurt other factors that drive demand, and likely are going to have, almost certainly going to have a recession. I don't believe we've had a recession to this point, even though you do potentially have a couple of negative quarters. You just cannot have a real recession when unemployment is as low as it is. So I think there's a fair amount of work to do. I'm somewhat optimistic that perhaps this will be a more moderate recession, perhaps a bit lengthy, but if things work out well, we'll avoid an extremely deep pullback. But I really don't see how we're going to get through what the Fed's trying to accomplish without having more pain from an economic perspective in the weeks and months ahead, and almost certainly that will impact risk assets and bring prices lower. Okay,
that's very helpful. And we'll connect some of those dots in a bit, because I just want to make sure that everybody who's leaving and listening and leaving this both live and then also recorded later is going to be able to connect those dots, right, about how all these things are impacted. And we'll get to that in a second. But dating back, let's get into a bit of data maybe, right? Because dating back to the end of 2021, the Fed started the path of both interest rate hikes and shrinking its balance sheet. So maybe first off, as it relates to these actions that the Fed can take, can you just define these terms real fast, just to ensure that everyone's on the same page?
Sure. So the Fed has two main tools in its toolbox. I'd say the primary tools. One are interest rates. So the Fed directly controls short-term interest rates, and they set these rates. And that's going to impact things such as credit card payments, adjustable rate loans. It impacts a lot of corporate funding costs. It doesn't have as big of impact on, fixed rate mortgages and things like that, as those are longer dated rates, which the Fed does not control as directly. So the Fed directly controls short-term interest rates. When we talk about the Fed hiking interest rates, it's specifically those very short-term interest rates. The second tool that they've been using rather extensively in recent years is their balance sheet. Heard the term quantitative easing, when they were essentially, to just keep it simple, pushing cash into the market. And now we've turned to quantitative tightening. So think about taking cash or liquidity out of the market. That's the simplest way to think about it.
Sure. And I guess more specifically with the second piece of it, with taking it out of the market, can you give examples of where they're taking the cash out of the market specifically?
Well, without trying to get too technical, the Fed simply is letting their they've bought a lot of bonds. So when you buy bonds, you essentially take those bonds out of circulation and put cash into circulation. Well, the opposite happens when they let these bonds mature. Those bonds go back into circulation because, of course, the government has to refinance those, and then the cash gets taken out of circulation. So this is what they're doing. They're essentially allowing more bonds, think government Treasury securities, to be put into circulation and then taking the cash out of circulation. It's just trying to think of a simple way to explain it. That's the simplest way I can think of it.
Yeah, that makes sense. And I mean, just as it pertains to anybody, who may be asking, like, how does this affect me, right? How does this connect to me? This also relates to investments you may have, right, in stocks, things like that. That's cash that's being taken out of the market in general, right? So that's kind of how it connects. But before we go, today's episode is really cool because as anybody who's listened on an ongoing basis, we've been kind of traveling around the world and getting different, not just functional, but also country perspectives. But we just thought it was not just was it a milestone episode, but also a really important kind of inflection point to kind of get this out. But what's also pretty cool about today is we're going to dive into some data examples on here. So for the live crowd that's listening, Shaggy's going to drop some links in to be able to show some charts, things to look at. Going to be very cool to be able to look at. And even if you're not live and you're listening to this recorded, you'll still be able to follow along even without having the links and the charts that are in there. But it's going to be pretty data centric, which is pretty cool. So before we head down that path and we start digging into some data and metrics that people need to care about, let's ask the first question, which is, why should anybody who's listening, who may be an NFT trader or a project creator, care about what the US Fed is doing or the employment situation or any of these factors? Like, why does that matter?
Yeah, well, I mean, everything starts with the macro. When people are feeling very confident and flush with assets, they are much more likely to take risks and commit a lot of capital. And a lot of that capital finds its way to very risky assets. So when you have that type of macro backdrop, you're going to see those risky assets such as maybe small cap equities, NFTs, crypto tends to do relatively well because people feel just very confident in their personal situation. Conversely, when you have a macro backdrop where growth is slowing, potentially recession is looming, people are potentially going to start losing jobs. They're not going to feel as financially confident. Well, people are much less likely to take risks. They want to preserve the capital they have rather than trying to grow it. And they tend to buy much safer assets during that period of time. So this is just kind of the cyclical nature of investing. And, that is after kind of having a really solid asset allocation, and diversification, which I think is really kind of a bedrock of investing. The next thing I look at is where are we at in that cyclical cycle, because it tells me what areas I should be favoring based on the macro. And then you can continue to dive down deeper. It doesn't mean that certain projects can't do phenomenally well, even in a bearish economic backdrop, because there is the micro that comes into play as well. And it's just taking a step back and looking at the overall market. What are the general trends? And I think it's important to know those trends and kind of where we stand in those.
Yeah, that's great. That makes a whole lot of sense. So I do see everybody's questions coming in. I'll make sure that they get answered if they don't get answered along the way. So I'll either weave them in appropriately or bring them on the backside. But with all this in mind, Shaggy, that we've been talking about so far, what's been the path on the Fed interest rate adjustments and balance sheet shrinking so far? And where do you think we're going? And if you have any data that you want to share, feel free to drop it in as well.
Yeah. So on the Fed balance sheet, I'm going to drop a chart in. Let me pull it up here. And this chart is, I'm going to put it in the office hours chat. This chart is going to show the Fed's balance sheet. And so think of this as liquidity. Think of this as cash the Fed has put into the economy. And you can see that, a couple of decades ago, we were at under $1 trillion. They began this quantitative easing tool in 2008, 2009, in response to the financial crisis. They had essentially moved interest rates, which are their primary tool, down to zero. Well, they couldn't very easily move them below zero, at least here in the U.S. Some other countries have tried and done it, but here in the U.S., we cannot move interest rates below zero. And so they needed another tool. And they were like, well, a good way to get the economy going, because at that time, inflation was extraordinarily low and growth was still too low and interest rates are zero and it wasn't moving. So they started quantitative easing, which was essentially putting this liquidity in the market. So you can see, if you look at this chart, you can see the gray band marking a recession. You can see coming out of that recession, the Fed was really pumping liquidity to get things moving. And it worked. They continued that for many years, again, because inflation at that time was extraordinarily low. And rates were already at zero. So this was their tool to continue to grow the economy. They just started to take some of that liquidity out in 2018, 2019. They were on that path when COVID hit. And this kind of changed everything because rates were already extraordinarily low. They couldn't move them, again, below zero. So they had to pump an extraordinary amount of liquidity or cash into the markets in response to us shutting down the economy due to COVID. So the recession around COVID was extremely short-lived, simply because of the massive amount of action that the Fed and, quite frankly, the government as a whole took to respond to shutting the economy down. And you can see the Fed just pumped a massive amount of liquidity. We were at about 4 trillion, a little under 4 trillion of liquidity from the Fed at that time. And we peaked out at almost 9 trillion or recently. Now, the Fed, this has led to, of course, the boom. We've had just an enormous boom. A lot of people have made a lot of wealth despite the COVID shutdowns. In fact, many people at the middle to upper end incomes have done extraordinarily well. They have a lot more wealth and capital than they did pre-COVID. But of course, this has led to an effect that is now very problematic, that being inflation. Essentially, too much money was pumped into the system, too much government support was pumped into the system, and it's had the effect of having this inflation problem. So the Fed's response, as we're talking about here, is to begin to reduce this liquidity and also to raise rates. So they have raised rates a number of times now, 75 basis points, very big rate moves over the last several months. And I fully expect another 75 basis point move at their upcoming meeting here in a couple of weeks. At the same time, because that is not enough, they're starting to take this liquidity out of the market. You can see they've just started to take a little bit out, only about a little under 50 billion in June, a little under 50 billion in July, a little under 50 billion in August. Well, when you're talking about 9 trillion, 150 billion is a very small amount. But now they've doubled it. It's escalated. It's now 100 billion a month. Still relatively small. You can see in this chart that it only begins to start to shrink their balance sheet. But this will all add up over time. The rate impact over time, and now 100 billion a month, that adds up to 1.2 trillion a year. So it takes time. It adds up. It's cumulative. The other thing to note is that when the Fed takes these actions in terms of raising rates or pulling liquidity out of the system, it takes time. It's not an instantaneous impact into the economy. Usually a lag of about 6 months. So we're just starting to begin to see the impact of Fed rate hikes that started in the late spring. And this is going to have a cumulative impact over time here as we go into the fall and winter. So it's definitely going to start slowing the economy down more materially and hopefully bring inflation down at the same time.
Yeah. So, again, for anybody listening live, listening in the background, if you're not familiar, right, when he's saying 75 basis points, right, he's saying 0.75%, which may not sound like a lot, right? But when it's happening multiple times in a row, 75 basis points, 100 basis points, et cetera, right? I mean, we're talking about rates that are commonly, single digit rates, sometimes double digit, right? I mean, it's a big amount actually compared to that, right? So over time, it does create impact and people change their kind of their method of being. And if anybody's looking at the chart that's in there, I mean, the simple takeaway to really take is how directly up the chart is going and how it's only one minuscule amount tipping over on the top right corner where it's like curving down a little bit, right? That's the real takeaway, I think, to really take from this balance sheet shrinking chart like Shaggy's pointing out. So, Shaggy, how should anybody listening be thinking about inflation? So it's flatlined, right? But it's still quite high at this point. So how does that also impact the Fed's decisions and the economy?
So the Fed was very clear, both at Jackson Hole and recently in Powell's speeches, that inflation, number one, is a big problem. It's very painful, especially for those at the lowest, those lowest earners, as kind of those core goods, food. You have to have food to live. You have to have gas energy to drive, right? Those kind of those main drivers that a lot of lower income folks, the majority of their budget is used up in housing, food, and energy. Despite wages going up, they're going up at a slower pace than the cost of these other goods and services. So this is extremely insidious. It's extremely painful for those lowest on the economic scale. And the Fed has made very clear that this has to be rectified. We just cannot allow inflation to maintain at these levels because it just has so many painful and insidious impact to everyday Americans, people around the world. And so the Fed has been very clear that they will not rest until inflation is down close to their target level, which is 2%. So this is a big move to get down to 2%. Now, we've seen a lot of positives over the last couple of months. Here in the U.S., most of us have seen gas prices come down rather significantly. Now, we could get into why that's happening later if you would like. It's not all simply positive, but nonetheless, we've seen those energy prices come down. That's been a benefit. But what you are not going to see come down quickly are rents. That is a very big component of these inflation data. And food costs have been rather expensive if you go to the grocery store. I know I've noticed almost everywhere those food costs going up. And so we're not going to see inflation go from 8% down to 2% overnight. It's going to be a long process. Now, could we see it go from 8 to 6 to 5? Yes. Is the market potentially going to cheer if you see these declines? I think so. But I think it's temporary. This is the same mistake the markets made this summer. They were certain that, okay, inflation now flatlining, great, we're going to get the Fed before long. They're actually going to be cutting to help us out. And no, I don't think this is going to happen. I think the market has read this all wrong. And I really believe that the Fed is not going to bail the economy out this time. It just can't. It cannot have a double dip or a double peak in inflation as we did back in the late 70s, early 80s. It has to be beaten. And I think the Fed will be convicted in beating it. So this is my main thesis. This has been for some time. I do think, however, the Fed will slow down without question. But these cumulative impacts of this cumulative impact of everything the Fed has done is going to start to build up on the economy, and we are going to see growth slow, and we are going to see the labor market weaken. It's going to happen. Timing wise, I think we may still be a few 3, 4, 5 months away from kind of seeing the real impact there, but it's going to happen.
Yeah, so hold that thought on the labor market because we're going to get to that in a second. But before we get there, one of the questions from our audience is, we talked about targets on the inflation side of things, right, and getting rates to 2-3%. Does the Fed have a target, also a balance sheet target as well, in bringing the number down?
Not specifically. I think they'll probably give themselves a little bit more. I think they'll give themselves a little bit more freedom on the balance sheet side. What I mean by that is if we start to get to a period where we are slowing the economy and the labor market struggling a little bit, and we have some type of extraneous event, some kind of shock on the markets, if the liquidity becomes an issue, because that's really what the Fed's doing with their balance sheet, is putting liquidity in the markets. If liquidity becomes an issue, I think they could pause that or even increase that balance sheet a little bit under such a scenario, because they don't want the markets to stop functioning, and you need the liquidity for markets to function. So I don't think they have a specific target in mind. I mean, obviously they would like to get it as low as possible over the coming years, so that they have more firepower, if you will, the next time we have an issue. But I don't think there's a specific target in mind there. Just at the current pace, about 100 billion a month will be reducing.
Right. Which is, like Shaggy pointed out, a very small number compared to the total liquidity that's in the market. So related question to Shaggy, which is, what methods do they take to remove liquidity from the market at hundreds of billions per month?
Yeah, so this is pretty simple, actually. They have a very large balance sheet, as you saw in the previous graph, almost 9 trillion. Well, they have an enormous amount of bonds, particularly Treasury securities and some mortgage-backed securities as well, maturing all the time, well in excess of 100 billion a month. So this is very easy. So they just buy, they replenish their balance sheet at 100 billion less than they would to keep it flat. So if you think of a $9 trillion balance sheet, if I was not going to be quantitative tightening or quantitative easing, if I had 200 billion of bonds mature in a month, well, I'll have to go out and buy $200 billion of bonds just to keep my balance sheet at 9 trillion. So if I want to reduce my balance sheet, if I have 200 billion maturing, I only go out and buy 100 billion this month instead of 200 billion, and thus my balance sheet reduces by 100 billion. So this is a very simple mechanism. They're not actually selling bonds per se in the market. They're just not buying as many as they did in the past to replenish their balance sheet.
A related question that too, also from our crowd, is regarding the bond market. One of the folks in our audience has heard that the bond market is broken. Is that something you've heard also? And if so, do you have any thoughts as to why that's the case?
I don't think it's broken. I'm not sure exactly what that's in reference to. Debt markets, bond markets, they are by far the largest market in the world, by far. They dwarf the equity markets, and of course massively dwarf crypto markets. So bond markets are, I would say, if you want to look at one place kind of where there's a lot of really, really smart money, you would go to the bond markets. I don't really view them as broken. They're there to help fund capital needs, and they do an extraordinary job of that. If there's a specific question as why you might think they're broken, I'm happy to answer that. But the bond markets are working pretty efficiently.
Okay. So, you were kind of leaning into this a little bit, about 3 or 4 minutes ago, but let's maybe talk about the labor markets for a second here. So how do the labor markets fit into everything that's happening? And, again, I think given the nature of what we talk about here, we're of course always connecting it eventually to, Web3 and NFT markets and how it impacts investors and traders, on the riskier side of assets. But can you make that connection? How are the labor markets fitting into all of this?
Yeah, well, the labor markets, as we all know, have been very strong recently with not enough people to fill the number of jobs, companies having to raise the salaries and what they pay folks. And so that all feeds into inflation. As people can make more, they spend more. But when I just dropped a link in the office hour chat that looks at the unemployment rate, and I think what's extremely interesting about this, and everyone should take note of, you can notice with all the gray bars here being recessions, the labor market gets to its lowest point. When I say lowest point, I mean the unemployment rate is at its lowest point. So the most people employed before recessions. It happens every time. So a very low unemployment rate is a precursor to a recession. It has to be because, again, this is the main driver of most individuals' kind of wealth and spending. It's their job, how comfortable they are in their job, and how much money they're making in their job. So the point here being that when people are making a lot and they're very comfortable, they spend a lot. Inflation is high. And so, then you have to have this period where the Fed engineers a slowdown where things become a little bit more painful so that people don't feel as comfortable. They don't spend as much. They don't have as easy of time finding jobs. And, if you notice in this chart right now, unemployment rate is an extraordinarily low level, the lowest level we've seen since really the 70s, maybe even going back to the 50s. And this is just a precursor. This tells me this is a necessary condition to happen before a slowdown, before a recession. And this just, again, validates kind of what my outlook is that, a recession, a period of negative growth, a period of higher unemployment is coming. It just is.
Shaggy, do you have any either data or thoughts related to this in terms of how the participation rate intersects with this too? Because, part of what we're hearing, there's the definition of unemployment that exists, right? And then separate from that, of course, is participation rate. Do you have any data or thoughts in terms of how participation rate is impacting this as well?
Yeah, sure. Well, I mean, COVID kind of changed everything, or it sped up everything. Might be a better way to look at it. Folks figured out ways to make income, or perhaps they decided they didn't need the income. They wanted a different quality of life that they experienced maybe outside the office during COVID, and many are kind of loath to return or have found alternative ways of living. So. So this is a bit problematic because obviously this shrunk the labor force, and that's when you talk about the participation rate, the folks that are willing to go out and participate. So you simply have companies looking for workers, but essentially kind of fewer workers that are willing to work. So companies had to compete for those workers. So this is part of the reason we see these low unemployment rates. And, it would be nice if everyone would just decide to go back to work in kind of traditional jobs. But that just doesn't seem to be the case. So you need time. You need either time for, folks to emerge from school, join the labor force, replace a lot of these people that are retiring or moving out of the workforce, or you need to kind of create less demand for workers. And, the Fed just doesn't have the luxury of time. And so they're intent on kind of creating less demand. We just have to see, less demand for workers, people to feel less comfortable in their employment situation for essentially for those prices to start to cool off.
Yeah. And so, just building on top of what Shaggy's saying, right? Like what the flow of events that kind of happens, right, is people start to feel inflation. They start to feel that they need to be able to pay for things, of course, right? Pay for food, pay for rent, pay for other things. At some point, that typically tips people back to go to work, right? And, the traditional sense of work, right? Like the boomer sense of work, let's call it, right? But, given COVID, what he's suggesting, right, is that's not what's happening, right? People are trading, creating projects, doing their own thing, all that good kind of stuff. From a different vantage point, in a weird way, I happen to really like or find times like this a bit exciting, but more from like an entrepreneurial side of things, because what winds up happening, like one of the comments Shaggy was making, right, is reduced demand for labor, right? So what kind of winds up happening, I feel like sometimes in these really tricky macroeconomic situations is innovation. A lot of innovation happens. And in this case, the innovation could be something such as more automation, more tools to be able to replace human workers to be able to solve that kind of a problem, right? There's just one solution that could exist. So I'm at least partly excited, and maybe a sadistic way, but like partly excited by times like this, because I feel like if you're motivated to create your own project or own innovative thing or whatever it is, like there's no time better than right now to be able to create something like that, because there are so many problems and needs to be able to solve. So I'm just putting that in there as like a partly funny, partly sadistic thing, but partly exciting thing. If you're an entrepreneur and you want to create something, it might be a pretty good time for that too. So, Shaggy, shifting gears over to the international side of things. So this includes, Russia, China, Europe in cases, and we'll hit on that in a second because I know one of the folks in our crowd has some questions about Europe. Even beyond that, right? I'm not sure if everyone knows, but there's at least 10, 15 countries that are defaulting currently as well. Some usual suspects, but then some less usual suspects like Sri Lanka, Argentina, etc. What are your thoughts there about the international situation and how that impacts what we're seeing in the U.S. and in markets in general?
Yeah, I'm not overly concerned about some of the defaults we've seen out there internationally. I mean, Russia was technical. Basically, we wouldn't let them pay their debts, so they defaulted. Most of the other countries, relatively minor. Argentina, they default on a regular basis anyway, for the most part. So, I'm not seeing anything out there that would be too systemic. That would concern me from an emerging market debt perspective at this point. There's still tremendous amounts of liquidity, as kind of demonstrated from that Fed chart. Other central banks have pumped in liquidity as well. So there does not appear to be any kind of significant spillover, and that is well down on my list of concerns.
Okay. And, I think related to that, one of the questions from our crowd is kind of regarding the contrast maybe between European markets and U.S. markets, for instance, which is, I think the expectation that they have is that the European markets are going to be hit much harder this winter due to energy crisis and maybe other issues. Is there a scenario you see where the U.S. has more of a soft landing recession? I think you a little bit hit on this earlier, but a soft landing recession maybe relative to the European markets in the upcoming months or beyond that?
Yeah, I mean, without question, Europe is in a more precarious state. They didn't really have the growth here that we had in the United States. Yet they have the inflation problem, and now they have a massive energy problem that has the potential to be fairly serious over the winter. We'll see how that develops. But if I'm picking investment themes today, I would be far more comfortable investing in the U.S. here than I would be in Europe.
Yeah, that makes complete sense. And I guess maybe a related question here, and maybe you can clarify a bit more, Aqua, but I'll try to get the question right for you here. But someone else from our crowd asked, any thoughts on monetary Armageddon very possibly happening? I think that's related to the question that you're saying right now. But Aqua, if you have any clarifying, any specific points you want us to hit on, we'll let Shaggy go and make sure to put a follow-up question if you'd like as well.
Yeah, I know there's been concerns I hear them all the time for a long time, whether it's with the debt loads that developed countries are building, or with the monetary policies that countries are running. Are those both problematic? Yes. Do they have very long-term consequences? Yes. I don't think it's anything that anybody is going to have to really worry about for well over a decade, probably multiple decades. So eventually it will catch up to us. I don't think there's anything imminent or anything even in the near intermediate term around countries' levels of debt or monetary policies that are going to have enormous impact. Of course, this inflation problem, yes, but we're dealing with it. We will beat inflation. I'm quite confident of it. How painful it's going to be to beat it, well, that's kind of the $1 million question. We'll have to see, but I don't really worry about kind of the Armageddon type scenarios over the next decade or two. Eventually, potentially, yes.
So I want to shift gears towards the NFT side of things. Of course, we have a good amount of NFT traders, investors, builders. from our live crowd who are going to listen later. So I want to make sure we give them some nuggets or at least some thought or a framework to work with. Before we go over there, Shaggy, is there any other data or charts or anything that you think we're missing that we should be accounting for? Or do you think we've pretty much hit the main ones at this point?
Yeah, I'm going to put one more chart in the office hour chat. And, I want to show this. Let me see if I can pull this. Give me a second and see if I can pull this for a longer date range. Let's see. So you're gonna have to click into that chart and click on the max to see the longer date range. It's pretty simple. And if anybody, I would just put this out there. If anybody wants economic data, the St. Louis Fed maintains a database. Simply Google FRED, F-R-E-D. The amount of data and charts, all for free at your fingertips, is massive. So if anybody's interested in charts and data, especially economic data, it's a extraordinary resource that's free. This particular chart that I put in, and when I talk about the bond market being massive and being what I would view one of the kind of the smartest markets in the world, one particular metric I watch extremely closely, being in kind of the bond business as well, is the difference between 10-year Treasury yields and 2-year Treasury yields. And if you click on this chart and max it out, you will see that very predictably, short-term rates, so 10-year or 2-year rates, move higher than 10-year rates 6 to 12 months in advance of a recession, almost without fail. Very few, if any, false positives. So it's an extraordinary forward-looking predictor, the bond market telling you kind of what to expect from a macro perspective. We've had those short-term rates higher than long-term rates now for many months since June. They continue to persist. This is just an extraordinary indicator with a high degree of confidence that would suggest that a recession or slowdown is likely at some point over the next 6 to 12 months. So I just wanted to mention that one particular chart. If I had one data point I would watch to tell me what the macro was looking like, it would be this one without fail. It is just, to me, the best predictor and best forward-looking predictor out there. So, I just mentioned that. Now we can kind of shift gears over to the NFT side. Yeah.
So that's very helpful. And so before we get over to the NFT side, maybe just from like a more generalized perspective, is it again, overgeneralizing here, is it safe to say if we think the macro is turning down, if we think we're heading into some version of a recession, that the generalized impact is going to be risk markets like NFTs are going to be impacted? Is that like all opinion, of course, right? But is that a reasonably simple takeaway to make from history?
Of course. Very simple. And just think about it. If people are feeling a little less confident, perhaps not have, maybe their stock portfolio isn't doing as good, or, their job prospects are a little bit more challenging. Are people going to take really risky bets? Generalization, no. People are going to try to hunker down and kind of persevere and survive through the more challenging times. And that's a very kind of a broad generalization. But I mean, you already see that in NFTs, right? I mean, look at the floor prices of any significant project, whether it's the Moonbirds or Proof itself or Azuki. I mean, you can go down the list. They're all down significantly, not only from an ETH basis, but from a dollar basis. They're all down massively from their peaks. And this is just a function of people, trying to preserve capital, trying to hunker down, trying to make sure they have the resources they need to make it through more challenging times.
Yep, that all makes complete sense. I'll give the one little nugget of hopium that exists, right? Because historically, the two things that tend to go both with the economy and against the economy as well, even when the economy's downturning, are alcohol sometimes, and then also gambling. sometimes as well. Casinos sometimes do well in down markets. So I will throw that out there for whatever it's worth. But otherwise, I generally agree with you. So shifting into a bit more specific, and maybe as people who are traders in here, we could focus on traders, investors, that side of things. One of the folks in our audience is saying, 15 million, daily NFT volume that's out there. Where, if anywhere, are you looking for opportunities, or maybe, how are you thinking about that?
Well, one thing that anybody who's been here for a while realizes, especially in these markets, is that the opportunity is where the liquidity is. It's just that simple. The challenging thing in the NFT market is this liquidity moves around so quickly. So you can see any type of project, it gets some eyes, get some liquidity, provide some great trading opportunities. The trick is to figure out and get out before that liquidity dries up. So, if you look back a year ago, liquidity was everywhere. It was, everything had liquidity. It was so easy to sell NFTs at any point and generally make a lot of money. But the thing that's really challenging right now is, that you look at that daily volume. It's not a lot, but it just kind of moves around from project to project. So, that's the challenge, especially for traders, especially for people that in this space looking to make kind of short-term profits, is, just following the liquidity and staying in front of the liquidity. If you get behind liquidity, you're going to have problems.
As someone who's sitting on at least 6 commoners right now from a couple of weeks ago, I can use that data point as an example of that for whatever that's worth. So couple upcoming events are actually happening, Shaggy, right? So we have, one is the ETH merge is coming. I think it's literally in days, right? I think it's September 10 to 15 or something like that is what I heard. Also, upcoming is midterm elections as well. Any thoughts in terms of these normally big, positive, let's call it, for markets events, and the impact that it might have? Is the macro going to overwhelm these events? What are your thoughts there?
Over the long term, the macro dominates. Over short term, no. The short term, you have lots of impact. I think the ETH merge is very interesting, and I'm no expert on it by any means, but it becomes a bit more deflationary, I believe. Don't quote me on that. I just think that ETH has a great use case. I'm just really bullish on ETH in general over the long term, just because of its use case. I don't see the use case in Bitcoin or some of these other major chains, as we have kind of the smart contracts and some kind of really exciting things in Ethereum. And to use a lot less energy, it just has a lot of positives, I think, to build the use case. So I don't really focus so much just on the immediate, because I don't know if people are trading in front of the merge or after the merge. I'm just not that smart on it. I do think in the long run, it's going to be a positive, and it will, assuming everything goes successfully, it should be relatively positive for Ethereum over the long term. Just increase kind of its usage, I think. So that's my opinion there. The midterm elections, I don't think that's of much impact. I think for the most part, the result is already baked in. At least here in the U.S., the House of Representatives almost certainly will go to the Republicans. The Senate, much more uncertain, but it doesn't really matter. If one goes, then essentially we'll have gridlock for a couple of years. That's not necessarily a bad thing for markets, by the way. Markets love gridlock for the most part. So don't view that as a bad thing. I just view the election outcome as kind of already baked in. I think probably if you're looking for another really big, impactful near-term event, the inflation data, CPI data that we get coming up here on the 13th, and then PPI on the 14th. That inflation data is going to be very impactful for that Fed meeting that's coming up. So some of the near-term data points I'm looking at, but
yeah, that makes a ton of sense. And I think From one other perspective to maybe offer as it relates to the Ethereum side of things, right, is I think there's this balance also. What Shaggy's, of course, saying is short term, any big event could potentially overwhelm the macro, right? The degree of that, who knows? But like any positive event or negative event could do that. Just one other consideration for that, though, right, is there's this balance, of course, that we've all seen in so many projects in terms of hype, right? Hype that's being pushed online. I think we all, or many of us, generally agree that like the technology is very valuable, but in the short term, the balance between hype, but then also the fact that technology, just in general, almost always, when rolled out, has some kind of problems that exist, right? And so, oftentimes, I feel like when hype gets pushed out there, it's very easy to to think about all of these positive things that we all know are likely to come in the future with the technology, and sometimes overlook or neglect like the risk that exists in terms of issues that could come up or problems, and equally like the perception of those problems. So that's not me at all suggesting that, it may not be a good outcome or things might go wrong, or, I think it's likely that some things go wrong. I think it's likely that some issues exist. It's just a question of like how much you want to balance, how much the hype and the future value kind of pans out, in prices in the short term, or if there are issues that can get in the way, and just making sure you're taking like a balanced perspective, right, in making your decisions. That's all. So with that all said, I just want to be cognizant of time as we're getting to the end of the hour. I want to be really appreciative. First off, Shaggy, 1 all the way to 20 now. It started with you, so very appreciative of your kicking it off with us and your time today, of course, and the really thoughtful discussion and the data. So very appreciative of that. To the crowd, to the live crowd especially, extremely, extremely appreciative of everyone there who tunes in, today, but who tunes in on other days as well, and always asks questions or gives feedback to us. Really, really appreciative of that. This is all designed for all of you. As you can tell, my only role is to get answers out of our guests and make sure that they make sense to everybody, right? That's my only role. Couldn't do this, though, without all of you guys. So I very much appreciate all the feedback and questions and thought that you all have. And certainly to everybody that's been helping behind the scenes as well. Really appreciate it. So just again, want to say a major appreciation for hitting episode 20 now. And trust me when I say we've got newer and better things coming along the way on our path to episode 100 too. So thanks everybody for everything. Really appreciate it. And we'll see everybody in VC1 like usual.